Australia is sitting on one of the biggest mismatches in personal finance history. Savings accounts at the big four banks are still paying under 4%, yet the cost of living across Sydney, Melbourne, and Brisbane has climbed so aggressively that even modest inflation is quietly destroying what everyday Australians worked years to build. And here's the brutal truth. If money is just sitting in a term deposit right now, it is losing ground in real terms every single day. So the question isn't whether passive income is possible in Australia in 2026. The question is, why are so many Australians still ignoring the strategies that are already working right now? This is not a get-rich-quick blueprint. This is a structured, honest breakdown of what the data, the platforms, and the current regulatory environment actually support. Because in 2026, passive income isn't a fantasy, it's a framework. And the Australians who understand it are quietly building wealth while everyone else waits for the RBA to do something about it. Let's get into it. The Reserve Bank of Australia held its cash rate at 3.85% through the first half of 2026, following a series of cuts that began in late 2024. On the surface, that sounds like relief, and for mortgage holders, it was. But for savers, the relief evaporated fast. Term deposit rates at the major banks have compressed back toward 3 to 3.5% annually, well below the headline inflation figures that have kept grocery bills, energy costs, and housing expenses stubbornly elevated across every major capital city. The Australian Bureau of Statistics confirmed that annual trimmed mean inflation, the RBI's preferred measure, remained above 3% into the first quarter of 2026. That means a term deposit isn't just underperforming, it's delivering a negative real return for most households. And this environment isn't temporary. Structural forces, from global supply chain shifts to domestic energy transition costs, mean Australians cannot afford to rely on the traditional savings playbook any longer. The mindset shift required is significant. For decades, Australians were told, work hard, save, buy property, retire. That model isn't dead, but it's no longer complete. The new wealth architecture in 2026 involves building income streams that don't require constant time input. Assets that generate revenue while the owner is asleep, on holiday, or doing something else entirely. That's the true definition of passive income, and it's more achievable than most Australians realize. One of the fastest-growing passive income categories in 2026 is what analysts are now calling digital real estate. Not cryptocurrencies, not NFTs, actual income-producing online assets, websites, content platforms, and affiliate channels that generate automated revenue from Australian consumer spending. The 2026 boom in niche AI-assisted content sites has created a genuine opportunity for Australians willing to invest upfront time or capital into building targeted online properties. The mechanics are straightforward. A well-positioned website targeting a specific Australian search query, think best ride-on mowers for Queensland acreage, or NDIS-approved occupational therapy equipment Sydney, can generate consistent affiliate commissions from retailers like Bunnings, Catch, or Amazon Australia around the clock without ongoing manual input once the content is live. What makes this particularly powerful in the Australian context is local search engine optimization, or local SEO. International competitors, particularly large American content networks, consistently underinvest in hyperlocal Australian queries. Small market segments like best solar battery storage Gold Coast or budget caravans under 30,000 Western Australia are often dominated by small, targeted Australian sites precisely because the big players don't bother. That's an opening, and smart operators are walking through it. Beyond affiliate sites, automated lead generation funnels represent another scalable digital income model. Local service providers, solar installers, NDIS consultants, mortgage brokers, physiotherapy clinics pay significant per-lead fees to anyone who can reliably deliver qualified enquiries. Building a landing page ecosystem that captures and routes local leads using tools available at minimal ongoing cost can generate consistent fee income with very limited day-to-day involvement once the system is running. The upfront investment in digital real estate is intellectual rather than financial, which makes it particularly accessible. The barrier isn't capital, it's knowledge and patience. But for those willing to build it properly, the compounding returns of an established digital asset are genuinely impressive. Now, beyond the digital world, the share economy is generating real passive returns for Australians who think creatively about their existing assets. Peer-to-peer platforms for caravan and vehicle rentals have matured significantly. Australia's caravan market has remained one of the most active in the world. Demand for recreational vehicle hire surged post-pandemic and has not meaningfully retreated. Platforms operating in the Australian market allow caravan owners to list their assets for hire, with some operators reporting annualized returns of 15 to 25% on the value of the asset, depending on condition, location, and availability. For a $30,000 caravan sitting in a driveway 11 months of the year, this represents a dramatic shift in asset utilization. Luxury and enthusiast vehicle rentals follow a similar logic. Owners of prestige vehicles in major cities can generate meaningful income during periods when those vehicles would otherwise sit idle. But here's one that many Australians haven't considered yet: micro-warehousing. Australia's e-commerce sector has continued its structural growth, and small online business operators are constantly looking for affordable, local storage solutions. Renting out a large garage, shed, or spare space to a small online business entrepreneur through localized storage apps can generate consistent passive income with almost zero ongoing management. The asset, typically underutilized domestic space, already exists. The income stream just needs to be activated. From a tax perspective, the Australian Taxation Office allows depreciation claims on assets used to generate income, and specific provisions around small business use of residential and semi-commercial space can provide meaningful deductions. Consulting a registered tax agent about the current financial year's specific provisions is strongly recommended before committing to any of these models, as tax treatment can vary depending on personal circumstances. For Australians who prefer financial markets, the ASX dividend landscape in 2026 offers compelling options, particularly for investors focused on sustainable, franked income. The Australian system of dividend imputation, or franking credits, remains one of the most investor-friendly mechanisms in the developed world. When an Australian company pays a fully franked dividend, shareholders receive a tax credit for the company tax already paid on those profits. For investors on lower marginal tax rates, this can effectively boost the real yield of a dividend stock well beyond its headline figure. For superannuation fund members in the accumulation phase, franked dividends are particularly powerful. In 2026, the sectors attracting serious attention for dividend income include sustainable energy infrastructure, companies involved in grid-scale battery storage, wind and solar generation, and transmission network infrastructure, as well as resource companies with strong cash flow discipline. Several ASX-listed real estate investment trusts, or REITs, have also maintained attractive distribution yields relative to term deposit rates, offering exposure to commercial and industrial property without the capital requirements of direct ownership. For investors who don't want to pick individual stocks, managed investment portfolios, including listed exchange-traded funds, or ETFs, offer diversified ASX exposure with automatic dividend reinvestment options. The set-and-forget model works particularly well here. Establish a regular contribution schedule, reinvest distributions, and allow the compounding effect to do the heavy lifting over time. On the emerging digital asset front, institutional-grade stablecoin yielding and liquid staking products have gained formal recognition from Australian financial regulators. Several ASIC-registered platforms now offer yield-generating products backed by government bonds or dollar-pegged instruments, providing an alternative to term deposits with comparable or superior returns within a regulated framework. These are not speculative crypto bets. They are structured financial products that happen to operate on digital infrastructure. But due diligence remains essential, and only ASIC-registered providers should be considered. There's one suburb story from 2026 that illustrates the broader wealth shift happening across Australia right now. In outer ring suburbs of major cities, places like Rockingham, south of Perth, Caboolture, north of Brisbane, and Werribee, west of Melbourne, a fascinating pattern has emerged. These are communities where median household incomes are modest, yet passive income adoption rates have quietly surged. Why? Because residents in these areas have access to larger land parcels, additional sheds and garages, lower cost of entry for digital asset development, and a strong local community of small business operators willing to pay for quality leads and storage solutions. The passive income strategies that work in Toorak or Mossman also work in Rockingham, but the barriers to entry are lower and the competition is thinner. This is one of the most underreported wealth-building opportunities in contemporary Australia. Geographic proximity to a CBD does not determine passive income potential. Capital, creativity, and execution do. Of course, no honest discussion of passive income is complete without a clear-eyed look at the risks. Digital content sites depend on search engine algorithms that can and do change. A Google Core update can significantly impact traffic to affiliate sites overnight. Caravan and vehicle rental platforms carry liability exposure that requires comprehensive insurance coverage, and not all standard policies cover commercial hire arrangements. Dividend stocks carry market risk, and ASX-listed companies can and do cut dividends during economic downturns. Micro-warehousing introduces questions of liability, council zoning compliance, and potential impacts on home insurance policies. In some local government areas, operating a commercial storage arrangement from residential property may require a permit or face restrictions. Due diligence on local zoning rules before activating this income stream is non-negotiable. And digital asset staking products, even the regulated ones, carry counterparty risk. The platform itself, not just the underlying asset, needs to be scrutinized. Only capital that can be committed for medium to long time horizons should be allocated to these products. The golden rule of passive income in 2026 remains the same as always. Diversify across streams, understand the risks in each one, and never rely on a single income source, no matter how reliable it appears. Government policy in 2026 has created both opportunities and constraints worth understanding. The Australian government's ongoing push toward renewable energy infrastructure has created specific tax incentives for investments in eligible clean energy assets, including depreciation accelerations for certain equipment. Small business operators, including those running digital lead generation as a registered business, may be eligible for instant asset write-off provisions, depending on annual turnover thresholds. The ASIC regulatory framework around digital financial products has tightened, which is ultimately positive for consumers. The 2025 Digital Asset Framework legislation created clearer licensing pathways for yield-generating crypto products, giving investors more confidence in identifying regulated providers versus unregistered operators. Superannuation remains the most tax-advantaged vehicle for long-term passive income in Australia. Voluntary concessional contributions above the standard employer rate can significantly reduce taxable income, while simultaneously building the capital base that generates future passive returns. The interaction between passive income strategies and superannuation optimization is an area where qualified financial advice adds disproportionate value. The federal government's Housing Australia Future Fund continues to influence rental supply dynamics in capital cities, which indirectly affects return profiles for property-based income strategies. Understanding the policy direction and how it shapes future supply is increasingly important for any Australian building a passive income portfolio with real estate exposure. So here's where everything lands. Passive income in Australia in 2026 is real, it's achievable, and it doesn't require being wealthy to start. What it requires is a deliberate choice to shift from the hours for dollars model to the assets for income model. It requires understanding which strategies align with current capital levels, current skill sets, and current tax situations. The feedback loop is the key. Every dollar of passive income that gets reinvested, whether into more digital assets, more ASX holdings, or more asset-based opportunities, accelerates the compounding effect. And with the right automation tools managing the operational side, serious passive income practitioners are running diversified income portfolios with less than 2 hours of active oversight per week. The checklist for getting started is simple. Identify one strategy that matches current available capital, whether that's digital, asset-based, market-based, or space-based. Validate the tax implications with a registered professional. Build the first income stream properly before expanding to the second, and then reinvest. Because in 2026, the Australians who understand passive income aren't waiting for interest rates to save them. They're building the income architecture that makes interest rates irrelevant. The only question worth asking now is, which stream are you going to build first?